You had mentioned one other thing too, and I don't know if that's a part of something we could discuss now, but you said opening up the candle to see what traded. What does that mean?
Well, as I said, we kind of look at this as without trying to overwhelm you all at once. We want to show you that there is more to a period than the open, high, low, and close, and this is kind of the first layer of that. And within the individual settings, there's a tremendous amount more for us to show you. But let me just go from kind of step one to something quite a bit more extreme. So if we actually open these candles up, and I like to use that word because, or that term, because that's essentially what we're really doing here.
Oh, wow.
Yeah, so within each period, now we can actually see all of the volume that traded at any given price. And we can see that broken down by what we call a selling effort and what we call a buying effort. Now, I don't want to confuse you, because a lot of people would say, well, if those are only buyers and those are only sellers, that's not really how the market works. No, every time you buy something, you've got to buy it from somebody. But what we do is we classify this volume based on how it came into the market. And so I'm sure you've probably heard the terms bid and offer. Anytime you've got a price in the market, markets are auctions. So we don't just have a fixed price. There's no, the price is $50.90. There's always going to be a bid at one price and an offer at a price above. So you've got sellers that are trying to sell higher and buyers that are trying to buy lower. And when someone crosses that spread and says, okay, well, you're trying to sell me something at a higher price, but I really want it, so I'm willing to buy that. Well, we strike that volume at the ask, or on the right side, because we're saying that because you are willing to pay a little bit more for something and just go across that spread, that you're essentially an aggressive buyer. You're saying, I don't care what the price is, I want to buy it. And that's basically what a market order is. The same would be true if I just said, well, I want to sell this, and I don't care if I've got to sell it for less than I really want to. I just want to sell it, and somebody picks that up and tries to buy it. Well, we put that on the other side of the period, and that sort of is indicative of selling volume. Now, again, every one of these has a buyer and a seller, but it's really more about how they engage the market than anything else. So inside of these periods, we're looking at every trade that took place for every price level, both by the buyer initiating the trade and by the seller initiating the trade. So within these periods, there's a tremendous amount of volume. And you can see with all of the numbers and everything else, there's a little bit of method to the madness for how we classify all of that volume. But in this case, everything that's in blue represents just kind of your normal print in the market. Just this is volume that transpired, whereas everything that's in green or in red indicates something of significance. This is where we had a strong buying effort into the market, or what in order flow terms, what we call a toxic event in the market depth. So what happens is we will see areas where you can see how here there are basically zeros, meaning that for when the buyers came into the market and started crossing the spread, there wasn't even anybody willing to sell into it. There were no sellers here, whereas the buyers that came in here were obviously very strong against almost no sellers at all. Well, isn't it interesting that when we have that snapback of the market retracing, where does it retrace to? Well, it retraces right to where that effort was by the buyer to basically eliminate the seller on the breakout. And these are the types of patterns that we can begin to identify in order flow, that somebody who's looking at a chart that looks like this, even with the extra information, they're flying blind.
Wow. I'm a little speechless because I keep visualizing just a normal chart and not really being able to see this amount of information. And it's not even really that it's more information, it's just organized past open, high, low, and close.
Well, that's been the tough part about this. We've been doing this for about 12 years, and when we first started out, the initial charts were just, here's a tremendous amount of information, and you think, well, gosh, that's fantastic, I love that. But we all know what analysis paralysis is. I mean, you get too much information on a screen, and you start reading too much into it, you don't know what's what. And so over the years, we've really worked with phenomenal technical teams to get this drilled down to a point where we're getting the best information that we can extract from the market, but putting it into terms that are very easy for you to adopt. And that's why generally the screen that I'm showing people is just this. I don't like to overwhelm people with all of the volume depth that's underneath there, because this picture right here shows so much about what took place. And I mean, just let me give you a very basic example here. We've looked at how this range breakout happens, and we see the volume that engages that range breakout, and we see that sort of move sideways but still rising and then turn into a substantial trend. Well, look, we know we sort of picked this at random, but now that we've stuck ourselves with this period, let's think about the volume that took place right here. And after the market moves up and starts to roll back over, isn't it interesting that where the market comes back to is the exact same place? So when people use those terms like, well, support becomes resistance and resistance becomes support, those are fun things for people to be able to say and quip, right? The trend is my friend and things like that. But in reality, there's a reason that resistance in this case becomes support, because we see the selling effort transition into a buying effort. And when we pull back into those levels, that's where the market is going to find the next group of buyers to come in and essentially fight off from that level. That is what creates a significant technical level in the market. People who look for key pivots and fib levels and GAN and all of these market technician tools that are out there, if they would just take those same approaches, just like you do with standard candlestick charts, and start applying that logic with the volume information that's there, the boundaries are limitless.
I keep visualizing as you're talking my previous trades that I've made just based on a price without really any knowledge of how much actually traded at a price. You know, I like to do things in metaphors in my head, and I'm thinking of like if you looked at 4 jackets in a row in 20, 21, 22, and 23, and just line them up deep, and you'd be like, all right, yeah, there's 4 there, and something. We sold 4 jackets, but you don't know behind like the third one there was a million of them.
Right.
You know what I'm saying? It's like that's how I'm feeling right now, and I'm visualizing. Yeah, it's 4 prices, and we place all of our stop losses at a price, but we have no idea if that price matters.
Well, and that's
like why I'm speechless right now, and that's hard for me to be, because like I'm trying to visualize what you're saying, but I'm not overwhelmed. I'm more. I feel like I'm not. I don't have enough correct information. I'm not going to say enough information, but this is, and just take for example like a breakout. So many traders complain about breakouts, myself included, but being cognizant, looking at this particular chart, you can literally see where the volume was to trade the breakout or not take the breakout. I mean, it's very clear in that trading range.
Absolutely. And while I think that most traders, when they're out looking for new information, are generally trying to look for something that tells them where to put on a trade, I mean, that just kind of is I guess that's more of the fun piece of the puzzle. If you think about the conversation that we've just had in the last few minutes, probably one of the more beneficial pieces of this is telling you that there is a point where that trade no longer makes sense, which is one of the things that, I mean, I'll just tell you from my experience, as long as I've been trading, I've been hearing people talk about putting stops below the low or stops above the high. And when you start to see where the real volume that mattered, that created the breakout is, well, it's here, right? There's probably a concentration between these two efforts, this neutral period that came up and traded into the selling effort, and then the buyers who actually came in and drove through it. If we traded back through those clusters, would you want to hold a stop all the way down at the low of this just because that's what you've been trained to do through books and other trading programs? It wouldn't make much sense. If the breakout takes, why would we be able to trade back through this buying effort? So placing your stop 7 ticks away instead of 27 ticks away, I mean, that's very substantial for most retail traders to start risking less so that they can focus on making a better multiple of what they are putting at risk rather than just hoping that every trade turns into a giant trend. I mean, there's no guarantee that this was going to break out and continue. The sellers might well have driven back through this. And if I had that kind of risk on a trade, I don't think I'd be able to do it successfully, at least not day after day after day.